So today we'll be doing the last part of our options and derivatives, which is option valuation. You guys can see my screen?
Yes, sir.
Yeah, okay. So now world of options, options valuation is a hot topic that's often used, that's often been referred to for the purpose of valuing any call or put option. So if you remember yesterday, I taught you call put parity, right? Now the call put parity I taught you yesterday was a very useful parity model that helps you to value a call or a put, but you can do that by reference to the actual value of a call, right? And a PVX and a stock, and you can find the missing number. Now, the missing number could be this, and I'm giving you this, this, and this. Or maybe a missing number is this, and I give you this, this, and this, right? But this is basically where I'm trying to give you the value of a call where a put is available or a put where a call is available. So therefore, I'm trying to connect the call and put, and therefore I'm giving you a call put parity. So this is one way of valuing a call or a put. And this way is obviously using the market way. And this is also called as a no arbitrage method. Because here what I'm assuming कि अगर market में put का और call का कुछ certain value is there, that means the automatically the other value of the call put should also follow. And if it doesn't follow, then there will be arbitrage opportunities. Arbitrage will enter, they will buy, sell till the market value is established. So here I'm trying to give you what the value should be in the market using the market factors. Okay. And keep reminding yourself, I taught you some quiz questions also where we said that you rearrange a formula. You can take this side, you'll get call value. If you take this side, you'll get put value. So learn to rearrange a formula so that you can understand these four symbols carefully. Example, this is plus. If it's minus, it becomes short. If stock is my plus, it is long stock. If it comes this side, it's a minus stock. Put co, if I take negative, it becomes writing a put. So learn these words very carefully because the options will not come in the form of a formula. The options will come in words. And if you don't know the words, you'll be caught up there. Clear? So that was one very important valuation method on which normally one question always comes, call put parity and the related variables. Okay. Now today what we'll do is a second method, which is again equally popular. Okay. And these are models that you and I can use. If I start going to some like Black-Scholes model and all, those models are not something that you and I should use or would use. Those are done by valuation specialists, people who have access to advanced models. Those people use Black-Scholes and all, right? So that we will not touch for now. So instead also realize that those are a little bit too advanced. For that, we probably need actual knowledge and some advanced systems knowledge, statistical knowledge. So that is not being specially covered. Okay? But this next method I'm going to teach you is a very important method that we use in normal corporate life and companies which have options. It's called the binomial method. Okay, binomial model. Now, rightly so, for the exam, we'll be doing either a one period model or a two period. So we'll have one period, one and two period binomial model in which you are required to value a derivative using the binomial model. Clear? Now, let's quickly understand what's the meaning of bi. Now, what is bi? Anyone knows? Bi, the word bi. Answer?
It means two, sir.
Two.
Very good. Very good. So two. So the word buy refers to, in the world of options, refers to two directions. There's only two options. There is no third way about it. And this is a very popular word in the statistical word where we say binomial means where there are only two possible options. Example, if I toss a coin, right? Either a head or a tail comes, right? That becomes bi. So binomial theory and models work in every scenario where there are only two possibilities. If your sentence is either true or false, right? So there are two options. So same way in the world of options, because a stock because a stock which is probably valued at maybe 50 has only two directions it might go in. Okay, so that is basically used in my binomial theory. So we know a stock can either go up or down. There's no other direction. I mean, constant is not a direction, it's just a state. So if you know that there are two possibilities, the binomial model picks up on this and says that, okay, the stock will go up or down. So therefore, let me consider an option valuation by using this binomial tree. So what they say is, let's assume that you have a stock and you have a call option. Let's say call. Okay. So let's say you have a call on a stock and the call is $60. Okay. Now let's say stock is $50. Okay. Now if the stock is 60, sorry, so let's say call is 55. Now if the stock is $50 and you have a call at 55. That means if the stock goes above 55, it will be worthwhile. If it is below 55, it is useless, right? So let's assume that if the stock goes up, it will go up by 20. But you have to also say that if the stock goes down, it will go down by 20. So 20% is your assumption. Clear? So let's do the maths. 20% of 50 is how much? 10. So that means if the stock goes up, it will go up to 60. But if the stock goes down, it will go down to 40. Clear? So that means you know the two movements, and you also now know that the call which was available at 55 is now worth how much? So tell me, if the stock is 60 and you have a call which is exercisable at $55, what's the value of the call? Answer?
For 5.
Very good. Guys, you got it? $5. So 5 is the worth of the call. If it goes up to 60, if the stock goes down to 40, what's the value of the call?
0.
Very good. Okay. So obviously here also is 0 unless there's time value. Here also. But here I'm getting 50. Now the game doesn't end here. We could go and say ठीक है यार एक काम करते हैं यहाँ से वापस ऊपर नीचे जाते हैं. If here it goes away by 50, it'll go 20%, it'll go to $72. If it goes down, it'll go to $48. Same here. If from here it goes up, it may go to $48. From here, if it goes down, it may go to $32. Then you'll say, okay, what's the call value? Now I'll say the call worth is almost 55, 65, so $72, right? But here, the call is worth 0, 0, 0, right? So what I did is I showed you the second period also. In real life, trust me, using Excel or using AI, it is possible to do for multiple periods. You can go on and on for 10 years also. 10 possibilities. I did just for one period, and remember exam is one period. But just to show you what two period means in real life also. Two period, and this comes in level 2, is extending it further to further the second period. And now you need to find out for me, what is the value of the call? That's it. So you know the call is worth 17 or 0 or 0 or 0. That is two period. Somebody say, nahi, yaar, two period, nahi, one period karo. Then fine. You stop here and tell me what's the value of the call. This is one period. Got it? Now you tell me, what's the value of the call in the one period model? It is either $5 or $0. Right or wrong? 5 or 0, clear?
Yes, sir.
So you tell me, what is that one value? Will it be 5 or will it be 0 or will it be average? What will it be? What value should I assign?
The average. Mhm.
Answer?
Average, because you can't
Average.
say it will be bigger,
Correct.
it will be higher or
Okay.
lesser.
Good. The other boy, what do you think is the answer? Other guy?
Yeah, same, sir.
Average. Okay. Now tell me, is there something else that you'd like to know in this scenario which I've not told you as yet? This may go up by 10%, 20%. This may go down by 20%. You got the value. But what else would you like to know to get the correct value apart from average? Answer? You
The
would like.
the probability.
Very good. Very good. Well done. That's what trying to ask you. Why I'm asking you this is because in the exam, they will not give you, but they'll expect you to find out the probability by using some formulas. And in the exam, you'll forget in the rush that you're supposed to find probability. Clear? Very good. So the correct answer is I need to find out the probability of it going up by 20 and down. And remember, the probability will never be the same. Never. So let's say there's a 70% chance it'll go up by 20, but a 30% chance going down also. Then you'll say, boss, 70% chance of 60, therefore 70% chance of getting $5. So the answer will be $3.5 plus 30% into zero chance. So the final answer is $3.5. Is that clear? Khatam. $3.5. That's your probability. That's your answer. Clear or not?
Yes, sir.
Okay, so there you go. So you need to find out two things. If it goes up, how much value will I get? Please make sure that you're clear with your options knowledge when you do that. The value rightly says 5. If it goes down, how much? Obviously, you'll always see that one answer will always be 0, mostly. Then you multiply by probability, then you accumulate the answer, and then you tell me the option value is 3.5. Simple. Are we clear? Same if I tell you 2 period, you'll say fine, 17 into, but don't forget, here also I have probability. Now you tell me, can you answer this question? What's the probability of getting 17? What's the probability? Answer. So guys, same concept I told you from the beginning. Probability क्या है इसका? Anyone? Answer?
Could you repeat?
I am saying simple question. $17 is when the price goes up to 72. What is the probability of the price going up to $72? That's all I'm asking you. What's the combined probability?
I can't figure it out.
Okay, you, the other guy? No idea?
Yeah, not sure, sir.
Okay, so look here. If I told you that there's 70% chance of it going up, that means after it goes up, what is the further chance of it going up? यहाँ ऊपर गया, फिर यहाँ से यहाँ ऊपर गया. Was the probability going up like this and then like this? It is 70% into 70%. The answer is 49%. Same here, 70 into 30. The answer will be 21%. 30 into 70, answer is 21%. And 30 is 9%. You'll notice the total of this also comes to 100%. 49, 21, 21, and 9. This answer is 100%. Clear? So when you take combined, when I took 70, 30, there also the answer came to 100 because that is first period. Second period, you have to take combine, multiply each one, and you get 49, 21, 21, 29 for each of the 4 scenarios, 9. And that total also comes to 100%. Khatam, job done. Is that clear or not? Clear?
Okay, sir.
So,
Yes,
got
sir.
it? So very important. Obviously, they'll ask you to value using 1 period, but they'll ask you concepts. Could be around 2 period also. This is the way you get the answer. So the answer would have been $17 into 49%, which is around $8.4 is the answer in a 2 period. And the answer in a 1 period is 70% into 5, which is $3.5. Okay. So please learn this concept very well and understand the way we are assigning probabilities in the end game. ठीक है? Good. So that's broadly the learning. Okay. Now you learned everything you need to understand. Now let me make you solve the sum on your own, which is important. Look, now remember this is very important, non-dividend paying, because agar dividend aaya, to my cash flow will also change. The non-dividend stock is trading at $50. So my stock price is 50, right? Now they are saying a call option is 55. Obviously, this is out of the market now, right? Out of the money. They are asking you if it's expected to go up or down by 20%, what price should be highest expected to get for the sold call option. Assume a rate of 5. Now 5 is important because if you remember, I did this 3.5 after 1 year. But if I want the value today, I'll have to discount it. I'll have to do 3.5 divide by 1 plus r raised to n, because this is my value today in year 0. Clear? So year 1 is 3.5, but year 0 ka value will be 3.5 divided by 1 plus r. Clear? Because remember we're doing one period model. So ek period khatam bhi ho gaya, right? So now you tell me what is the answer for this first question. Attempt only the first question. Okay, I want you to tell me basically what is the value. That's all. Start. It's very simple. Draw the diagram, put the variables, put the arrows, and compute. Start. With some water. Come on, guys. Answer.
So 59.76.
59. 59 ही हो सकता है.
And
No, what is the...
4.76.
Okay. The other guy, what's the answer? You got it? Right? So, if you look at this movement, you said 4.9. Other fellow, you got your answer?
They say 2.98.
2.98. Okay. Okay. Let me show you the, let me check. I'm not saying solution. Let's start. So I'm in time 0, right? Now, today the stock price is $50, right? I'm saying it could go up or down by 20%. So if it goes up by 20, it will come $60. If it goes down, it will come $40, right? Now, I'm also saying that there's a, okay. Now, here, what will be the call value? The call value, if it becomes $60, will be $5, correct? And the call value, if it becomes $40, will be 0, right? So if I take this, and let's assume this is 100%, the value of the call, maximum value, see, they're saying highest expect. I'm not asking you for the average price or the probabilistic value. I am saying worst case scenario, worst case. So worst case means, you're right, the girl said correctly, the worst case means $5 pura milega, because that's the worst case scenario. You can ignore this. Now the answer is actually $5, but, and you did rightly also, you need to find out that the value after 1 year is $5 was a value today, right? So what you'll do, $5 would be discounted by $5 by 1.1 plus r raised to 1 year. So 1.05 raised to 1 is equal to the discounting value. What is the value for, what's the answer for this? $5 divided by 1.05. Answer?
So 4.76.
4.7. I got 4.96. So 5 divided by 1.05 raised to 1. Sorry, 5 divided by 1.05. 4.76, correct. And that's your answer today. 4.76. Clear? Now, suppose he told you that there's a probability, okay, of say 60% going up, 40% going down. Then you'll say, fine, this answer is only 60% probability. So you say this answer into 60% gives you 2.86. That's a final answer. Clear? So very easy to solve. When they say find the maximum value, highest value, just take the 100% probability. When they say find the probabilistic value, multiply the probability into the respective values. Clear? Any questions? Okay. Now on that note, you guys tell me what will be the call option price for the second scenario? Answer.
1.90.
Okay. 1.90 नहीं हो सकता है because it's going up by 40, no? तो 40 मतलब ये 70 हो जाएगा और अगर ये
So
70
up
हो
or
गया
down?
हाँ अप और डाउन ना बट डाउन तो इग्नोर ही कर सकते बिकॉज वी लुक एट द हाईएस्ट पॉसिबल आंसर
Achha,
so
okay, it's
down
not the probability. It's going up by
but
40%.
also madam if it's probability also you know it's an option na if it goes down you will not be negative you will pay zero only na you'll be out of the money so you'll take zero amount you can't get negative amount if it goes down है ना ये कॉल ऑप्शन है ऑप्शन में there's no negative there's only zero see this अगर 30 हुआ तो 0 20 हुआ तो 0 10 हुआ तो भी 0 है 50 पे 0 मिलेगा अगर वो 50 के नीचे क्या योर एक्सेस प्राइस 50 55 so you won't expect anything to buy if it's going below if it goes above you'll get the money are we clear
Oh, yes, sir.
yeah तो ऊपर 70 गया तो you'll get 15 but ऊपर अगर 30 गया you'll get 0 right so the answer is $15 और $15 को अभी डिवाइड करो 1 plus r which is 1.05 raised to 1 15
14,
divided by 1.05 कितना आया
14.2.
29 perfect clear any questions clear makes sense what I did so you have to it's a very simple topic honestly but this can get complicated and it gets in level 2 but please get your foundation right in level ये बहुत डिफिकल्ट हो जाता है लेवल 2 में अगर तुम लेवल 1 नहीं समझो तो ये प्लीज ध्यान से पढ़ना उसमें बायोमोनियल 2 पीरियड 3 पीरियड करके परेशान कर देते हैं so you have to learn that which is very easy when you are clear the concept okay so quickly look at the solution 60 40 so your payoff will be 5 0 okay but remember payoff at period 1 so if they tell you what's the maximum payoff you can say $5 what's the maximum value today it will be $5 divided by 1.05 clear अगर ये period 2 का होता तो तुम $5 divided by 1.05 square करते because 2 साल का discount so just try to follow the norms see which period is there and take it accordingly clear any questions okay now the binomial model so we have one period binomial tree for stock price and we have call option okay now this is the solution 2 where we spoke out 40% see the answer 70 हुआ तो 15 30 हुआ तो कुछ नहीं right 15 का 15 मिलेगा और do into 1 upon 1 plus r where we got the answer as what 14.29 clear clear or not okay so don't forget to do discounting okay now a new concept last probably concept and additional concept is the hedge ratio now the concept of hedge ratio essentially talks about how many units of stock should I have in order to hedge my stocks okay now just quickly if let's go back to the question first if highest had a more optimistic outlook of the future correct now this is where they put probabilities that is they estimated a higher probability of the option ending up in the money how would the expected call price change now this is theory question they're not asking you to quantify what do you think the answer would be but they're saying key stock price had a more optimistic outlook on the future stock price right मतलब they are feeling that नहीं यार ज़्यादा probability है कि वो stock in the money हो जाएगा how would the expected call option price change answer would it change higher or would it change lower answer
It wouldn't change, right, sir?
it wouldn't change okay why okay no so wait the word let me clarify one important concept for you the word expected right you tell me what do you understand by the word expected answer what does expected mean to you
So what we can
Uh,
expect out of it, like it's not set in stone, but we can expect that much.
Sorry, it's not set in stone, it's not certain, it's uncertain, it's based on probability. Right or wrong? The word expected only means that I'm not sure, it's probable. You agree with this line? So, in real life, when I tell you to give me the expected value of anything, you will go and hit probability. Clear? Okay, learn this concept well. Expected is nothing but a culmination of probabilities. Clear? Any doubt on that?
No, sir.
Answer. Okay. So you'll see many sums, many statistical measures is there in CFA also. They'll tell you find the expected value. All you have to do is take the scenarios, take the scenario possibilities, multiply by the probabilities, and get the answer. So the word expected is always referring to a probabilistic estimate. Clear? But you can't use sentiments because what if you expect 30%, I expect 40%. None of us are right because your expectation is your feeling, right? Your gut, your judgment, your feel. I can't say you are right, I'm wrong. But even you can't say. Both of us can say we are right because that's our expectation, that's our feeling. Therefore, that's a problem because everyone might have a different feeling. So, judgment is very subjective. So, what we say, let us assign it probabilities. Now, you'll say assigning probability also is judgmental, right? But no, there are some scientific calculators and ways of finding out probabilities and finding out the this outcome. Clear? So, are we clear the word expected? Now you guys tell me, read this, tell me, what do you understand of the statement? Now it will make more sense to you.
So if we assign a higher probability, we'll expect a higher price.
Correct. Exactly. Very good. अभी समझा? So they are saying यार अभी तो मुझे लग रहा है कि there is more probability. The price going up, more probability because I'm more certain. Now it's very obvious now that when the certainty is higher, the value will be higher. If you feel stock surely will go up, or example, I don't know if you all know this, but when the elections happen in India, right, the value of the options became very jittery. But the moment they came to know, like earlier, they were like BJP, Congress, this undivided, so people are not sure. And both call and put options were both useful. The moment they realized that BJP might win the elections, the value of call options shot up because expectations shot up that the market will go up. The value of all the call options became valuable because the probability became high. And this is a real phenomenon. I'm telling you what I observed. I was very shocked with the way the markets moved. But as the virtual certainty increased, the valuation became higher. Why? Because of the word expected, which is connected to probability. Clear? So when I say that a higher probability is expected, it only means that the expected call option price will change more vigorously. Clear? Okay. Are we clear there or not?
Yes, sir.
Chalo, last question. So this is done. Last question. What would be the price of a 1-year put option? Oh, interesting. So now you need to do for me one thing. Tell me the same sum, but do it with regard to the put option. Okay. Now you know put option is the right to sell. So when the share price is below your stock price, your put option will have more value. Correct? This is the opposite. If it goes down, you'll make value. If it goes up, you'll say value is 0. Correct? So start. This is very simple, but थोड़ा उल्टा जाना है conceptually.
So if it goes up, like if it goes up by 10, then its value will be 0, because if it's put option, then if
Correct.
exercise price, and if it goes down by
No,
10,
this
its
exercise price
value.
55. Exercise 55, the price is 50. If it goes up by, don't say 10, take 20%. So 50
हाँ,
से अगर 60 हुआ तो it'll be 0, you're right. But if it goes down by 20%, then it is how much?
like
40, right?
yeah,
It
वो
will have
15
value.
वैल्यू होगा,
Correct.
15
Very
वैल्यू
good.
होगा ऑप्शन का.
Very good.
So 14.28 at 5%
Okay, very
risk-free
good.
rate.
Very good. So let's do this. So same way, acha, I want 20%, right? Yeah. So if it goes up, 60, if it goes down 40. But data मैं put की बात कर रहा हूँ. So if it is put option, the put option will be 0, correct? But यहाँ पे put option मुझे $15 देगा, right? Now $15 is at the end of period 1. So here it is $15 discounted by 5% for one period, right? तो कितना होगा वो? 15 divided by 1.05. Answer is 14.29. Correct? That's the answer. Obviously, I'm assuming best, highest, worst case scenario. Suppose I told you that there's a probability, जो मैंने पहले ही बोले 70-30% chance है, तो क्या करोगे? 15 into 30% and that discounted. So 15 threes are 45. So you do $4.5 divided by 1.05. Right or wrong? Correct?
Yes, sir.
And that into 30% will give you 4.29. Okay. So again, in the exam, worst case scenario bola to 100% probability le le. Agar expected bola probabilities diya. So the point is, if they give you probabilities, then you will work it out like this. Clear? Very good. Chalo, perfect. So that covers our 4. So the 4 questions that we finished doing is on call, on put, and we discussed the expected. So this is a very good example where you'll notice a lot of critical concepts got covered. Okay? Please make a note of the solutions base. Now let's come to a very interesting concept of hedge ratio. Okay. Hedge ratio. Now what is hedge ratio? Before we go to solution. Hedge ratio is where I'm trying to hedge my losses. अभी मैंने बोला कि ऊपर गया नीचे गया ऊपर गया तो इतना होगा, but how do I ensure that I'm always protected? To do that, I can do something like this. I can buy stocks and I can short calls. Okay. Now let's understand the meaning of this. What is the meaning of buying stock and shorting calls? Example, let's say मैंने Infosys का I bought 100 Infosys shares. ठीक है? Infosys shares at let's say dollars में $40. ठीक है? What I did, I went long on 100 Infosys shares. Market price $40 है. समझा? अभी I am going to go and short calls. मतलब I am selling calls. I am selling infy call. अभी कॉल का वैल्यू लेट्स से मैंने 40 डाला कि भाई तू 40 पे खरीद ले, मैंने बेच दिया एंड मैंने इस पे market premium कमा लिया. How much premium will I earn? Let's say I sold it for premium of $5. So I earned $5 premium by selling people the Infosys call. Clear? Obviously, if you sell call, you'll make a premium. Now, isn't this an awesome strategy of a hedge? Why I say that? Soon. Suppose Infosys share price goes up. तो साला ये कॉल तो तुझे पैसा हराएगा because he will say boss पैसा दे मुझे, मेरा कॉल का वैल्यू गया, he'll charge you money. If Infosys goes to 41, 42, 45, 50 हो गया तो ये बंदा बोले मेरा तो 40 का वैल्यू है, you pay me $10 so per share which is almost $1,000, right or wrong? Right? You'll have to pay him 100 shares का जो भी डॉलर इंक्रीज है वो वैल्यू उसको देना पड़ेगा. Correct?
Yes, sir.
Now, are you okay with that? Are you okay doing that? Yes, because you already have Infosys का 100 shares तेरे पोर्टफोलियो में. तो अगर Infosys बढ़ रहा है तो तेरा पोर्टफोलियो भी तो बढ़ रहा है. So this 40 becomes 50. तो तू तो anyway यहाँ पे $1,000 कमा लिया है और ये $1,000 तो उसको दे दे फिर. So you are basically protected कि भाई ऊपर गया तो 1000 जितना ऊपर गया उतना तेरा पोर्टफोलियो ऊपर दूसरे से तो उसको पैसा दे दे. You are not going to lose anything. But what you gained $5 from him free. तो तुझे जो $500 मिला 100 शेयर्स का ये तेरा इनकम हो गया. अगर ऊपर गया तो तेरा पोर्टफोलियो में है, give it to him and you don't lose any money. See, if you don't have the shares with you, then sky's the limit. You could already lost 5,000-6,000 rupees, dollars. But here, because you already have the shares, you lose nothing. But the beauty, if the share goes down, then this option is useless. 500 तेरा पूरा कमाई हो गया. But this portfolio shares also will go down. Right or wrong? बस ओके ना, बिकॉज तुम तो लॉन्ग टर्म के लिए खेल रहे हो. ये नहीं कि तुम्हें शेयर रख के बोला मुझे नेक्स्ट वीक बेचना है. तो अगर तुझे शेयर रखना है और यू गोइंग टू पुट इट डाउन, यू कैन प्रोसीड. Is that not making sense? So what are you doing by doing short call? You're earning premium, and in case it goes up, you have nothing to lose. But in case it goes down, you have the entire premium in your pocket, and the shares are anyway with you, which you can average out. Is that clear? This is a concept of hedge ratio. So what a hedge ratio explaining is, it will tell you कि भाई कितना स्टॉक्स लॉन्ग करना है और उसके अगेंस्ट कितना कॉल्स को शॉर्ट करना है उसके अगेंस्ट. Is that clear? So that means if I have 100 Infosys shares, I may not be needing to short 100 derivatives. Got it? I may need to short only maybe 20 or 30 or maybe 80 or maybe 140. So it's not 1-to-1. So how will you come to know how much to short sell? Simple. Look at the ratio formula. The ratio says how many stocks you'll sell. How many stocks is nothing but the difference between the call price upon the difference between the stock price. This is called hedge ratio. As simple as that. The difference between call price and the difference between stock. So if my example, the call price is 5 and the difference, right? 5 and 0, right? And when I'm saying the difference is the difference in the binomial chart, correct? So if you look here, right? When it went up, your call became 5 and 0, but stock became 60-40. So the difference in call price 5 and 0. So the difference in binomial 60 and 40. So it's 5.20, which is 0.25. Clear? What does 0.25 mean? It means that these many stocks you will go long for every call that you'll go short. That means if I have 100 stocks, I will have to sell 400 calls. Understood? Because it is 0.25 times. Now are we clear? So if you are having 100 shares, please go and short 400. Only then you'll get a perfect hedge. So hedge ratio helps you determine how perfect your hedge actually is. Clear? Any questions? Any questions, this guys? Okay, if there are no questions, now you tell me. ये तो तुम लोगों ने कर दिया. Everyone answer this aspect. Please take a minute to learn this well. Can you please complete that? And now tell me, what will be this answer for the second case where the stock went up or down by 40%, right? And call ka value is something different, right? And the stock value also went up and down in a different manner. Give me the answer, the ratio for the second scenario. How many units should I long in order to hedge my short units? Okay, start.
That's 0.375.
Very good, well done. Fantastic. So you know that if the call option value goes up, it's 15 and 0, but niche I took 70 and 30. Correct? So 15 is divided by 40, and that gives you 0.375. Clear? Any questions?
No, sir.
Well done. Sure. So this is the concept hedge ratio, right? Which you find out shortly. And then let's prove it to you now. Okay, let's say uh, you actually ended up longing 0.25 shares and you sold one call. Okay, 0.25 one call. Okay. Now look at what happens. If the share price goes up, तो 60 हो गया, तो मतलब तूने तो 0.25 शेयर्स खरीदा, सो तेरा yeah, you can take 1:4. You can say that for I will long 1 and sell 4, but for now it's 0.25:1. So तूने तो 0.25 शेयर्स खरीदा, तो तेरा वैल्यू ऑफ शेयर्स तेरे हाथ में, तेरे जेब में कितना है? $15 का शेयर है, बिकॉज तूने 0.5 खरीदा, पर तूने जो कॉल शॉर्ट किया, right? The share price went up, right? So you lost how much money? $5, remember? So therefore you lost $5. So the total value in your hands is $10. Okay? $10. Now let's do downside. अगर नीचे गया, let's say it became 50 से $40. So मतलब तेरे पास अभी है $10 ही, but अभी short call का value भी 0 है. So effectively, you still have $10. So this is proving to you कि भाई ऊपर गया नीचे गया, मेरा हाथ, मेरे जेब में $10 value ही बचेगा. The value is the same in either state. Same value रहेगा, उधर भी $10 और यहाँ पे $10. Now you will wonder कि इसके आगे भी नहीं कर जा. You can't say 60 के बजाय अगर 55 हुआ तो और 45 हुआ तो. You need to stick to only 60 and 40. Why? Because this entire formula is based on the 60-40 mix. Clear? Okay. So this is the ratio which gives you the same answer no matter what. Correct? 0.25 and run. So now you guys, let's do one sum. You guys tell me, where is that? Oh, okay, this scenario only. You guys tell me, this is a scenario. Okay, now I'm telling you, I have longed 10 shares, but I have shorted 40 because the scenario ratio is 1:4, right? Now you tell me, what is the value after one period in terms of upside हुआ तो क्या value है, अगर down हुआ तो क्या value है, तेरे हाथ में. The answer should be same, but let me find out what is the actual answer. Can someone answer please? I'm maintaining 0.25:1 and I'm telling you, if it goes up, only one period, just do one more. If it goes up, what will be the value in your hand on account of the physical stock and the written call? Written call. Okay, understand. I want the answer for both up scenario and down scenario. Okay, answer. What will the value be? No idea?
No, sir.
Okay, don't look at this answer. This is the other scalar scenario. So the value would be, I told you 40 shares, 10 shares and 40 shorts, right? Agar upar gaya, right? It went up by how much? What's the value you're looking at? 60. So if it went up to 60, correct? What will be the value? 600. Right or wrong? But the call is giving you -5, correct? So you are losing 200 there. So you will have 400 in your pocket, correct? This is the up scenario. Now the down scenario. If it goes down, it will have gone to 40 and you have 10 shares. So 400. but the value is 0 and जो 40 है उसमें 0 value है उसमें 0 है, you are again ending up with $400. Is that making sense or not? You're earning $400 if it goes up by 20, if it goes down by 20 also. Clear? Proved it? $400. Any questions? Now you
Yes, sir,
notice,
understood.
yeah, you got it. You'll notice this answer works only when it goes up and down by 20. If it goes up and down by 40, this answer will not work because I already showed you and you worked it out that if it goes up or down by 40%, तो ये आंसर काम नहीं करेगा क्योंकि मेरा hedge ratio अलग है. My hedge ratio will be 0.375 in the scenario of up and down by 40. So the point here is for every up and down movement, there is a different hedge ratio. Understood now? There's a completely different hedge ratio based on the quantum of the movement in the up and down. Are we clear now? Sorted? Abhi tum batao. Last sum I'll make you do. You know it's 0.375. I'm giving you a scenario. I went long 0.375 units of stock. I have to long per short. So look here. I'm saying I went long 375 shares and I shorted 1000 calls. Right or wrong? Ratio hua, right? I went long 375 shares. So this ratio is 0.375 to 1. Now my question is, when the stock became $70 or the stock became $30, I want you to prove that value is same in both scenarios. Start. Are we clear now? मैंने बोला 375 शेयर और 1000 कॉल शॉर्ट करके तू मुझे बता कि how come the value is the same even though the stock went up and down by 40%? You'll still be in the same answer. लिखो भाई अपना बुक खोल के लिखो या एक्सेल में स्टार्ट. Tell me the value in both the scenarios. Answer. Value कितना है?
Sir, for the first one, is it $26,250?
Okay. 26,250. And the second one?
Would be 30,000.
Okay. So you know that hedge का मतलब है value should be same. Okay, let's see. Now, first one means, and the girl, you got the answer? First one means,
Calculating.
okay, the stock became $70 and therefore the call is worth $15. In the second scenario, the stock became $30 and the call is worth only 0. Now find the answer. Compute the answer.
So is the first one 11250?
Very good. Very good. Yes. And second one? And the girl? Do you get that?
I got
So
the
Kiran,
second one, 11250,
good.
375 into 30.
Kiran, if the first one is 11250, मैंने बोला क्या hedge में the answer should be same both. The second answer also should be 11250. Okay, chalo, let me prove it to you quickly. Good. Both of you are going right. You all found different scenarios, but the answer is consistent. Let me prove it to you. If the stock is 70, और मैंने कितना बोला 375 shares. Brilliant. But मैंने बोला 15,000 shares. Calls. So here I lost $15,000. But I also made how much? 70 into 375. 70 into
26250.
yes, 70 into 375. 26250. So what is 26250 minus 15? 11,250. Khatam. Now come to second scenario. $30 के हिसाब से तेरे पास कितना शेयर्स था 375. So that comes to 11,250. But 0 के हिसाब से तूने 1000 बेचा तो कितना है 0. Answer 11,257. Answer same. Right or wrong?
Yes, sir.
Clear? Perfect. Perfect. This is exactly how you will solve it. Kadam, work done. So see how I'm proving to you कि भाई अगर ऊपर नीचे 40% गया तो hedge ratio has changed to 0.375, and I'm also proving that using this hedge ratio, when it actually goes up to 70 or goes down 30, you will have the same 11,250 in your kitty. Not a dollar more, not a dollar. Samjha? But obviously the mess up in this is, what if it goes up by 30%? तो क्या तूने 40 का हिसाब दिया, अरे 40 का हिसाब है तो 40 में ही काम आएगा. It will not work in 30, 20 or 50. Sure? So hedge ratio is usable only when the up and down movement is playing within a parameter that you are comfortable with. Got it? Clear? Good. So you need to learn this not from just Ajay, hedge ratio formula kya hai, difference upon difference. Not that easy. You have to also try to prove how, when the amount is actually going up or down, the amount of in your hand is the same whether it goes up or whether it goes down. Just like the example. But this is too simplistic example. Okay, 11.25. I showed you a more difficult example. Clear? देखिए some answers. वही prove करके वही दिखा रहे लोग. Clear? See, here it's come to around 10 point, no, 12, 10, 9 point something, 9.52, right? और यहाँ पे भी I think comes around, yeah, 9 point something, ठीक है, 6 or something. So you'll see the answer same in all the scenarios. Clear? Okay, sure. So this is how the hedge ratios are potentially being met. Okay, and how you put it down. Any questions so far? So what we've done binomial, we've done the one period model, then we went to the situation, we checked how it works in both up, down, maximum, lowest probabilities assigned here. Then we went to hedge ratio. In hedge ratio also we went to up and down, what is the amount, and we did different percentages, right? We did 20, we did 40, and we found out at different percent was the different amounts, and we found out how at that percentage that will give you the exact same value. This is the hedge ratio part. Any questions so far? Okay, good. Sure, perfect. Now this part is completed. Now we'll go to the last part, which is some of the theory about risks, ratio, and so on. Okay. So just give a quick 5 minutes break, guys. I'll just get my laptop charged to the wire and we start. So just a 5 minutes break. Try to recap all this knowledge that we done. Note it down. Okay. So now the last 2 bits with regard to valuation, we'll compute the up and downward movement. You guys can see a screen, right? Yeah. Hello.
Yes, sir.
Yes, sir.
Okay. Okay. Now, so like I told you, the last missing part in this entire thing is how to get the probabilities and how to use that to compute the exact value. Okay. Now, the actual probability, you know that it may never really be known, and it will also not affect the value because we are trying to find out the highest price. Okay. So probability will always be something lesser than the highest price. Correct. And you can always offset the highest value. Okay, offset the risk of selling the cash call by purchasing H number of units. So basically, the hedge ratio I told you is protecting you against the worst case scenario, right? Any directional views on the stock will not affect the hedge positions. Why? Because in hedge, I told you what's the difference between stock and the call, considering 20% up and 20% down, right? But if the actual probability might be different, then that will not change the hedge ratio per se because the probability is not there in the formula for hedge at all. Now let's enter the world of hedge, the world of probabilities. This is very important, guys. Let's understand this carefully. Okay. What you're going to now learn is 2 formulas. One, I am going to give you what is the scenario for going up and down. Okay. Now using that, in my earlier example, I told you that if it goes 20% up or down, right? Now understand that this will result in two things. Your value, which was 1, might become 1.2, and the value which was 1 could also become 0.8. Clear? So this is one learning, that the value in the up and the down will be 1.2 and 0.8. Now let's learn how to compute probabilities. What is the probability of the value of the stock moving up? Now this is actually called the risk-free probability, the risk-neutral probability. Okay, yours, if it goes up, it will go up by 20%. But what is the probability of it going up in the first place? That we don't know. And I told you in the exam, they won't even give you that probability. But you need to find out that probability by using a set of formulas. Okay, now I'll teach that formula to you. The probability of it going up, and that also going up by 20%, but going up, is 1 plus risk-free rate, which is obviously going to be given to you, minus D. Now remember, D is nothing but the value where it goes down, which is obviously going to be less than 1. So it cannot be negative, right? Divided by U minus D. Not as U minus D, the difference between the top value when it goes up and the bottom value when it goes down. That's it. That's all you need to do to find out the probability of it going up by 20%. Let's solve it. What is risk-free rate? 5%, right? So it is 0.05. What is the down value when it goes down? 0.8. What is the value when it goes up? 0.2, 1.2, down 0.8. So this gives you 1.05 minus 0.8, 0.25 divided by 0.4, which means 0.25 upon 0.4. Yeah. How much is that? 50, 62. Which means that there is, ignore this one now, okay? Ignore this part. Don't look at this right now. There is a 62.5% chance of it going up with a 20% hike. Clear? Because don't forget, 20% also important because I use that in the UND. Now you tell me, if there's 62% chance of going up, what is the probability of it going down? Answer? Answer?
1 minus 62%.
Brilliant. Everyone knows that probability is equal to 1. Sum of all probabilities, right? So therefore, if you give me the up probability, because I know we are in a binomial, two possibilities. So 1 minus 0.625 is going to be the probability of going down, which is 37.5%. In the exam, you need to solve this because they will expect you to solve the sum using probabilities. And you realize by now there is no direct hint also to find probabilities because this formula will contain RF, D and U, which is already given to you in an indirect manner. Are we clear? That's your answer. Now you found out the probabilities. And again, do remember the total has to be 1, otherwise your sum will not solve. Now, because you have probabilities, right? Now, can you find out what is the value of the call option? Remember till now I was teaching you without the probability, right? Now you have probability. So now can you find out the value of call option? Yes. Same diagram, 50. You know that it may go up by 20%. It may go down by 20. So when it goes up, it becomes $60. When it goes down, it becomes $40. But you know 60 pay, the call value is only $5. And 60 pay, the call value is 0. But $5, there's only how much chance of winning money? There's only how much chance? We just found out. How much is $5? Huh? 62.5%. Very good. And this, there's a 37.5% chance. Hey, Hannah, this answer comes to how much? So now do this. 5 into 62.5, 3.13. Correct? Got the answer? And here it is 0. So can I conclude that the value is $3.13? Correct? Now they ask you the value today. Is it the value today? No. This is a value in year 1, right or wrong? Correct? मुझे चाहिए आज का value. So क्या करूंगा मैं? Answer?
Discount at the risk.
Very good. So at year 1, my value is 3.13 plus 0, right? इसको मैंने आज का किया तो मुझे वो 3.13 लेना है and I'll divide it by 1.05 for year 1 and that will give me 3.13 divide by 1.05, 2.98. 2.98 is the value of my call option. Case khatam. Clear? Now the last, and this is connecting the knowledge to what I did yesterday. I have the call option value, and now I'm going to tell you, find out what will be the put option value in the same scenario. क्या करोगे? Will you do binomial? Tuck value 0 वो करोगे? Well, that is an option. You could do that. You could say tuck करके यहाँ पे put option 0 रहेगा, but यहाँ पे it'll be something positive. But the better answer is what? Do the call put parity. समझा? तो अगर ये सब करके बोला कि call put दोनों का value निकालो, तो call you removed by doing 2.98, right? I got 2.98. Now this is my fundamentals. Now tell me what will be the put value in the same question. Simple. You know stock price is currently $50. You know exercise price is $55. And you know that you found out the call option is $2.98. So can you find out the put value? Obviously. Do the maths. Go on, start. Solve it. See how easy it is, right? When you connect all the dots. What's your answer? Take your time, understand carefully. I hope you are asking the question, sir, what is the risk-free rate? It is 5%. वो भी चाहिए तुझे. Don't forget. Come on.
So 5.35.
5.35. Okay. 5.35. Let me check. 5.35. Very good. Well done. Fantastic. ठीक है? The other guy is silent. Kiran, I think.
I'm calculating, sir.
Okay, take your time. Calculate. So, and always remember, it is the same I taught you yesterday. Covered call, put, don't ratify the formula. Remember, what's a protective put? Stock. Stock को protect किससे करोगे? Put. So stock protected by put is left side of the equation. Right side is covered call. Means I took a call and the call, I need money, which is present value of X to buy the call. Correct? This you put the formulas. 50. I don't know P. I know 2.98. And I know that 55 is my exercise price. And that's present value is 1.05 is to 1. Correct? If you rearrange the formula, 2.8 plus this goes on that side, minus 50 ho jayega. The answer comes to 5.36. Kiran, you got that?
Yes, sir.
Perfect. Ho gaya? Sorted?
So just a question. So when do we use this risk neutral probability concept?
All sums. Whenever there is a binomial sum and they are asking you to find out the binomial values, 1 period or 2 period, you have to use the risk neutral free probability because this concept is valid only in the binomial world. You'll notice the formula is what? 1 plus r minus d, right? What is d? What is u? U and d are nothing but the values where it goes up or it goes down. So whenever I have a binomial sum which deals with up and down, I'm dealing with risk neutral property. So to answer the question, it's only in the binomial world that you'll use risk-free property. Clear? So when you get a sum in the exam, and trust me, this is 90%, I'm sure of it. When they give you a binomial one period sum, they are going to expect you to find out the property using the risk-free risk neutral property. They'll expect you to do that. Okay. Which is why I want to make you do one last sum on this using this concept of risk neutral, right? Now you got the answer as 2.98 and you found out that, right? So now you guys do this, okay? Do the risk-free neutral, okay? Let's just do a good question on this. Look carefully at the sum, okay? Now I wanted to apply. It is the sum is going to be very simple, but it attracts a lot of additional questions. Let's say a stock is trading. Okay, this is English. At today, let's say $30. Okay. Now, options available at exercise price of $25. Now, obviously, $25 means a call option is great in the money, but a put option will be out of the money, right? Now, the question is, consider binomial one period model, right? Of, I'll do this time 10% up and down movement. Okay. And the question is, what is the value of a call option and what's the value of a put option? Data, and I'll make this 28. Okay. So this is $28. Okay, exercise price. Start. Consider binomial one period model, 10% up down, and tell me how much will the value of call and the value of the put option. Start.
The up move and down move about 10, right? 10%.
Yeah. 10% is always going to be same for up and down. You can't take 10 up and 15 down. It's the same percentage up and down. They'll not change that. The probability will be different, but the up and down will be same. Start.
So risk-free rate, can I put 5%?
Yeah. No, wait. Risk-free rate, you put it as, put 5%. Yeah. Normal standard sum is always 5%. If they ignore, they will never ignore it, but it's always taken as 5. Take for now. Leave that. Continue.
So call option 3.57. And my put option would be 0.24.
Okay. And you'll notice that call option is much valuable because it's already in the money. You're buying 28, the value only 30. So you're only making value today. So correct. Okay, that girl was the answer.
So, 1 second.
What's the call? You said
3.57.
And put is 0.24.
Yep.
Can you tell me what is the time value of the call option? What's the time value? No idea, right?
So you mean like for both up and down, right?
No, what's the time value? I taught this yesterday. Okay. The girl finished the answer?
I'm putting it in the formula, but in the denominator, it would be 0.1 minus 0.1. No, I'm
No,
getting denominator is 0.
how can the denominator be 0.1? It is u. What is u? 1.1 denominator and d is 0.9, है ना? It is u minus d. U is 1.1, 0.1.
Okay,
समझा?
1.1. I'm taking 0.1. That's
No,
why.
it is in up movement means up. अगर ऊपर गया तो price क्या होगा? 1.1. If it goes down, 1 becomes 0.9. Understood? It is not movement. It is the value when it goes up and when it goes down. Okay, complete then. So what's the probability you got? 1 plus 0.05 minus D, 0.9, correct? Upon 1.1 minus 0.9. So is it 1.05? So is it 0.15 upon 0.2? So what is the probability you got, Kiran? Kiran, what's the probability of up and down movement?
So the first one is like my numerator is 0.15 and my denominator is
Correct,
0.2.
correct. Answer
So
क्या
the
Kiran? Probability?
0.75.
Good. So Chetna, you got the answer? So probabilities are 0.75 and 0.25, correct? Up and
Yes.
down probabilities so much. Did you get this much now?
Yes, sir.
Good. Now you get the answer. Now start solving the sum. If it goes up, it'll go to 33. It goes down, it goes to 27. Correct? Now, at 33, your value is 5. At 27, your value is 0 for call. If you want to do put first, put me karlo. Put me, if it goes up, the put is anyway still useless, but when it goes down, it's useful at $1, right? So you can do this binomial diagram using the call and the put. It's your choice. Okay. So if I say I'm at 30, 33 and 27, right? Now let's do both. Call option at 33 is useful. You get $5, but here it is useless. You get 0. Put option is anyway useless, but your put option you get $1. Samjha? Everyone got this? Now let's do the maths. What's the probability here? 75%, right? So that is coming to how much? 3.75. Correct? Here it is 25%. So here it comes to 0.25. Correct? Now the last step, you need to discount it to today's value. So this divide by 1.05 and this divide by 1.05. See how easy it is. It takes hardly a minute. In the exam, you should take exactly 1 minute. So this comes to 3.57 and this comes to 0.24. Right? Kiran, this is what you got?
Yes, sir.
Brilliant. And this is the approach you established. This is very, very, very easy, guys. They'll do 2 period in level 2. You'll be shocked. It gets easy, but you have to understand how to compute it. Clear?
So
And
is
then
it in level 1? Generally, they just ask
yeah.
one level.
Could you call me after half an hour, please? Yeah. So this is how we do level 1. 1 period model. Kiran, what are you saying further?
Yeah, sir. For level 1, CFA level 1, usually they just ask one period or they can ask
Correct.
two as well.
No, they'll ask only one. If the syllabus says one, they'll ask one. They won't go beyond the syllabus. In level 2, they surely ask you 2 period model. Okay?
Okay, thanks, sir.
And the level is much more higher, but obviously it's easy once you crack the concept. Okay, now last thing. I want to prove to you one more thing. Can you try and tell me using this answer? Let's see what does the call put parity say. Call is what? Put value is what? call plus PVX minus S, right? If I rearrange. So call value only got 3.57. PVX is nothing but 55. No, 55 no, 28 divided by 1.05. Correct? And what is S value? 30. So solve and tell me what is the put call parity. Try doing that. Chetna, you also try this.
So it's the same.
Very good. I wanted you to realize this, that you do the 2 period binomial or you 1 period or you do call put. You will get the same answer. And it's supposed to be the same answer because conceptually that is the way it should work. Samjha abhi? So again, like I told you, see, I showed you shortcut. You do this, tuck, you do call, put. One is always zero normally. You do this, you got the answer in one shot, you got both the answers. But in the exam, if you already had this answer, then don't draw the diagram. Do call, put parity. Answer will be the same. This is what I wanted to show to you, demonstrate to you. Are we clear?
Yes, sir.
Yeah, very good. And I wanted to appreciate this understanding because, and again, I'm telling you, level 1 is only a tip of the iceberg. Level 2, if you don't understand what I explained to you today, you will get more lost because these concepts will be more detailed, but your foundation is strong. Make your foundation very strong to play with various scenarios, how to get it so that period 2, even period 3, you can do it and you can crack it easily. But have a control on how to get the binomial tree right. Clear? So remember, put call parity, it works. Oh wow, so both will work. So get your knowledge consolidated. Okay? So with that, I have now completed complete risk neutral pricing, valuations, and so on for derivatives. Clear? Any questions? And you'll have done this sum also very well. This exact same sums, guaranteeing they'll always ask you one sum on this type, and they'll tell you to find the probability, valuation, call, put, and the movement. Clear? That's all what this topic is all about, right? If you see all my 20 slides are discussing only this, which is the heart of derivatives, valuations for 1 period model, right? If you look at the learning outcome, to answer your question, Kiran, what they said, explain how to value 1 period. So because they wrote 1 period, you can be rest assured they will not touch 2 period. Clear? Okay. And obviously the concept of risk neutrality, which is all my formula 1 plus RF minus D upon U. Ye zabardast formula. You have to learn it by rote. Don't miss it out at all. Clear?
So just one question.
Yeah.
Before we learn the formula for the risk neutrality probability, right? When we were doing some questions before this, we didn't apply the formula. Why
No,
was
I
that?
didn't. No, that's what I told you. I'll build it up. I told you initially that I will first teach you only the concept of valuation. So I'll go
Okay.
back to this question. If you see the question, I also told you what is the option price change over the next year. I first taught you this without the probability because here they asked you for the highest. I also explained to you, Kiran, that they asked what is the highest. So what does highest mean? Worst case scenario. Highest means if this will happen, there's no probability assigned to it. So in the exam also, Kiran, when they ask you for highest, do not assign probability. But when they tell you, give me the exact price or the value or the expected value, I also highlighted here, that is when you need to start assigning probabilities. So therefore, when the word probability or expected value comes, you'll need to go and say, oh, it's 1 plus RF minus D upon U minus D. But when they said only highest, just go with 100%. Clear?
But
So all these,
when they said highest in that question, right? I think they are
yeah.
just referring to the name of the company, right?
No, sorry. No, yeah, my bad. But what price should be the highest call? That means, no, what they said is what price should they expect for the call option without probabilities? Yeah, to actually should be highest. So if you see this answer I gave you, look here, the answer was without probabilities because this is the highest price they were expecting without assigning probabilities. Means worst case scenario. The worst case scenario was not mentioned to you actually, but this is without probabilities because it is the price expected for the sold option. Yeah, it should be worst case scenario. So therefore in 1 and 2, I have not used the probabilities out here. Okay, what is distinguishing between 1, 2, and 3? You tell me now. You read 1 and 2 and you read 3 and tell me what is the difference between the two questions. Answer. Read only
For
1 and 3. Tell me what
for
is
question 3, there's the keyword expected.
expected, right? And question 1, they said if it's going to go up or down, what price, right? They should expect to receive for the call option. What price? Okay, so here they're not looking at probabilities. They're looking at what is the scenario if it goes up by 20 or down, what price should I expect. So they are not trying to tell you to estimate the respective probabilities. Okay, in question 3, you're right. They said the expected price and obviously the estimation, and they're also giving you probabilities. So they're starting to play with probabilities in question 3. Question 4, and this is where the trick starts. They're saying, what would be the price of the option? The price of the option if it's expected. So here in the exam, expected to change price, you will start using probabilities. Why? Because they ask you the price and value, they'll ask you value, and they'll ask you based on expectation. Clear? Okay. So,
Okay, sir.
Kiran, in summary, in the exam, 95% of the time, you will be asked to play with probabilities. Okay. To assign probabilities, they'll give you the U and D, and you need to use that to find the probabilities. Okay, you may think it will take almost 5 minutes because you have to first find U, then find D, then find PU, then find PD. But it's not so difficult because you know my diagram will help you to solve the sum easily. Correct?
Okay, sir.
But be prepared to use PU and PD in the formula. And if you notice, that's why I started by trying to help you with the probabilities itself, because I didn't want you to forget that probabilities are important inputs in the equation. Okay? Okay. So
Okay.
worst case scenario, no probabilities. Expected value, you need probabilities. All right.
Okay, thanks, sir.
Welcome. So what I'll also do is I'll share the markups, but some of these notes, some points are coming earlier, some are coming later. I'll try to restructure and share this with you. But and one more thing, the hedge ratio. Please learn the hedge ratio carefully, and remember, hedge ratio does not take into account probabilities, but it takes into account only those scenarios of up and down. It will not work in another scenario. Clear? Because you know that the moment the percentage up down will change, the hedge ratio only changes. Correct? So that is a limitation of hedge ratio. Look here, when 20 is 0.25, but when 40 it becomes 0.375. So the hedge ratio is very uniquely available only for a certain scenario. Clear? So don't go. And also you learn how to prove that V is the same in both the scenarios. So you learn two concepts today: valuation up down using binomial, and two, hedge ratio up down using certain defined percentage increase decrease. Clear? So sir already showed you how to do questions. Maybe next week you can do chapter wise. Once you recap my learning from all the 4, I think we did 4 session derivatives today included, go back to the exam module and attempt every question on derivatives properly. You'll realize it's not as easy as it looks, but the more questions you solve, you will become more confident. Clear? Even this one, you found a little easy. Then give an example, you done your own, Kiran, you got that right. Right? And that girl realized that you should take 1.1, not 0.1. So you will find small mistakes you never realized. You'll find it out when you do the practice sums. Okay? But very important, because level 2, they will increase the percentage marks to derivative. Now I think it's only 5 or 7%. In level 2, it becomes almost 12%, 12, 14%. And level 3, they up the game because a big part of being a CFA, being an analyst, being a portfolio manager is how do you use derivatives to hedge your risk? Because investing is all about just investing and waiting, right? If tomorrow something bad happens, then your portfolio cannot be like wiped out. You have to learn how to risk and hedge your portfolio. Right? I don't know if you know this, but every company like Citibank, Kofa, I mean, every company and bank in the world, they do not close the office without hedging their portfolio. They are always, because they are obviously big companies, they have billions of dollars of investments. If tomorrow anything happens, they may have a loss of 400, $500 million, right? You won't believe at the end of every day, they hedge their portfolio using derivatives in such a manner that even if there's a tsunami or a militant or a airstrike or anything worse, COVID ho gaya, they will still suffer a loss of only 2 to 3%. They will not have a 20% loss. That is how important derivatives is. Then they do that only by using futures, forwards, options, and swaps. They cannot leave the office till they've hedged the portfolio. That is how the game. That's why Treasury and all, they normally wrap up by 8 o'clock, 9, because when they get the listing, they'll hedge everything and then they'll go home. Hedging is very important. Okay, so focus on derivatives, learn the details of what I've taught you, learn how to value it, and get your knowledge right. Okay, on this topic especially for CFA. Okay. Any other questions? Today, sir also taught you how to look at the question bank now. So use this for my past lectures also and start applying this for the future sessions, because without this, you will never get your concepts cleared on CFA level 1. Okay, guys? Any question? You guys already have the CFA book, right? The ebook. I think at the end of every chapter, there are some 6-7 questions. You can practice those
Yes,
also.
correct.
Yeah, उसमें है ना ebook में. So do that in the meantime till Amquest has the online questions which sir explained today. Okay, cool.
Okay, sir.
All right, Chetna, Kiran, any questions?
Sir, one
Yeah.
last question.
Go on.
Okay, for the hedge ratio, right? Because the formula that we learned today is
This
C
one.
C
C plus minus C minus.
C plus minus C minus over S plus minus S minus, right?
Yeah.
If the question is put, if it has a put, how will the formula change?
No, so the formula will change using. So obviously, this question is for long stock, short call. Okay, what you buy and what you are shorting. If the same question was for hedge ratio, it would not be long stock, short call, right? It would be, because a put is where you're going to have the right to sell, correct? So in that case,
Yes.
this hedge is only for a call, because remember, I can't go and sell a call without having a stock, right? Because I'm selling a call, because in case the call gives me a loss, my stock will give me a profit. So that profit and loss will offset each other. That's why it's called a hedge, correct? So if you were to have a similar hedge, but for a put, what will it be? It can't be long stock and short put, because the stock, you're selling the right to sell. So if you already have the stock and you are selling the right to sell, you will get more stock. So you lose more, right? It can't be a hedge. So what can it be?
Will it be long put and short stock?
Yeah, potentially long put means you have the right to sell, right? But why will you have a short, if you have a short stock, that means you have to buy it back. You have to buy it back, no? But a
Correct.
long put gives you the right to sell, not the right to buy. You understood?
Okay.
So that's also not a hedge. Potentially, what I can think of is a long stock where you have the stock, and a long put where you want to have the right to sell. So in case the stock goes down, the put will give you value and that will hedge the fall, right? Because you have the right to sell at a certain price. But that's already covered in a put call parity. It's called protective put, right? What's a protective put? You have a stock, long stock, and a long put. When I say plus, I mean long, right? So this is a hedge, correct? Right or wrong?
Yes, sir.
This is, so when you think of hedge, think that, array, will I be protected? If I did what you mentioned, I would have gone for a double loss, right? Here, If the stock goes down, so remember in a hedge, if one goes down, the other should go up. If the stock goes down, obviously the put will go up because put is a right to sell. So therefore hedge is working. Now come here. Now if I want to know what is the hedge ratio, should I long one stock for every put I buy or whatever? Here you can use a similar formula. But obviously remember here you won't do P plus P minus, you'll do P minus, right? Because P minus gives you more money when the stock goes down, and when the stock goes up, it'll give you less money. Right or wrong?
Yes, sir.
So the formula will be ulta, P minus and P plus, and same stock minus and stock plus, right? The formula would be reverse. But remember, it will be in a protective put. So don't go blindly and adapt this. So long stock short call is one hedge. Long stock, long put is another hedge. Okay. But don't forget,
Okay.
in a long stock, long put, you are not receiving premium, you are paying premium. So that's a little bit scary also, because you may be protected in terms of value, but premium तो नहीं मिल रहा है तुझे, तो पैसा कहाँ कमा रहा है? यहाँ पे तो premium मिल रहा है तुझे, right? So
Yeah.
you're earning money upfront and you are also protected your position. So this is a better strategy. Many people today, the big people, they do this. They'll buy stock, they'll short call, they'll make money on call. If the stock falls down, they'll say, "Okay, mera physical stock le lo." So they're sorted, right? And obviously not every time the stock will fall, will go up. So they're making money on the fall and they're protecting their stock also. Clear? So yeah, there are various hedge ratios, but your point is right. Put hua to ulta karenge. I understand what you're trying to say, right?
Okay, sir.
But that's not again officially a part of this syllabus, okay? But it may come
Okay.
later. But conceptually, you're clear. I think you got the right direction. That is good. Okay? Well
Okay,
done.
sir.
You'll realize level 2 will be shocked. There'll be straddle, strangle, butterfly, amazing strategies. You'll be amazed, but it's interesting. Okay. For now, they've tried to keep it a little easy because this is the start of level 1. Okay. I think others will follow suit later. Okay. Sure. Well done. Anything else, Kiran? Good questions. Chetna, you guys should start maybe in level 1 and 2, start doing some small investments. Buy shares, buy 5,000 rupees, 10,000 rupees shares, buy a few calls, maybe like 2,000-3,000, buy puts, and just see how it moves. You'll appreciate this knowledge I'm teaching you is exactly how it works in real world. You pay a premium, the premium value has time value, it has exercise value, the value will go down. Oh, I asked you a question you didn't answer. In the answer that you told me, Kiran, I told you what is the time value. You didn't tell me the answer here. Remember? 3.57. What's the time value? Again, this is what I told you yesterday. So if you look at the question, what's the value today if I exercise 30 and I can buy 28? So what's the value today? $2. Right or wrong?
$2.
Because it's at 30 and I can buy 28. So the value today is $2 to me, right?
Yeah, correct.
But it's still 3.57. Why? Because 1.57 is my time value. Abhi samjha?
Okay,
Chetna,
sir.
you got that? Yes, you also taught you this concept.
Yes, sir.
So the
7.5
premium, so this is how they can see. Don't expect them to ask you basic, simple questions. They could ask you, find out the call value, and out of that, what is the time value? So the answer is 3.57, 1.57. Some people may not get 1.57. So you have to connect the dots with everyday lecture. You can't say, हाँ वो कल हो गया, भूल गया. So I told you, I say premium is nothing but a sum of exercise value and time value. Exercise value $2, time value is 1.57. Balancing figure, right? That's a balancing figure because you know how to get $2. You know this is $2. So this is balancing figure. So I'm just trying to imagine how they test you. But you should also try to imagine, Are ye puch liya to. I keep doing it. When I study for exams like this, I always wonder what else they could ask. Acha, they could test this. Acha, this also could be the answer. So you need to go beyond the book. Don't go beyond the syllabus. Syllabus will never be 2-period model. They'll ask you 1 period. But 1 period mein kuch bhi puch sakta hai. You should know how to prepare for various what if. Again, not difficult, but they'll just try to test you conceptually. Remember, guys, level 1 is a conceptual exam. लेवल 2 में थोड़ा टेक्निकल बढ़ेगा, बट लेवल 1 में यू कैन नॉट से अरे मुझे कॉन्सेप्ट नहीं आता है, because they make it easy topics but conceptual topics. That's why you see I spend a lot of time to get your concepts cleared, because you guys are also new, fresh, you guys don't know much about finance to an extent, but at the end of level 1 you should know every concept, meaning क्या होता है, that's critical. ठीक है? And level 2 what they do ना, they'll pick up so level 1 if you see they'll teach you 200-300 concepts and they'll say abhi bolo. Level 2 they'll pick up 40-50 concepts and they'll give you the detailed knowledge. That's why level 2 is little easier because में क्या detail में घुसते हैं 40-50, but level 1 में इतना सारा concept सिखा देते हैं एक साथ, you will get shocked. But that's why you have to try to remember, try to know all the concepts without studying by rote. Try to study it with clarity. Understood? That is critical in level 1. Okay? Sure, well done. Okay, cool. Let's close on that note. Any question you guys still have, please make a note of it and we'll pick up in the next class. Okay, so I think next class, Sir mentioned we'll start portfolio management, right? Next Saturday, Sunday. Okay, guys? Yeah, sure.
Okay, sir.
Perfect. Take care. All the best, guys. Thank you. Bye.